I welcome all the speakers and all of you to this session on economic slowdown, inflation, government debt, policy priorities for emerging economies. We have with us Mr. Neelkant Mishra, Managing Director, Co-Head of Asia Pacific Strategy and India Strategist, Credit Suisse, and Member Economic Advisory Council to the Prime Minister of India. We have with us Dr. Sajid Z. Chenoy, Chief India Economist, JP Morgan, and Member Economic Advisory Council to Prime Minister of India. Dr. Chetan Ghate, Director, Institute of Economic Growth. Dr. Taimur Beg, Managing Director and Chief Economist, DBS Bank. Dr. Emila Skork, Lead Economist for India, Macroeconomics, Trade and Investment Global Practice, the World Bank Group. Moderating the session is Mr. Vilayan Subaya, Executive Vice Chairman, Tube Investments of India Limited. Sir, may I request you to give your remarks and take the session forward. Over to you, Mr. Vilayan.
Actually, I think given time and given that you're here to listen to the five of them versus listen to me, I'm just going to ask if Chetan can start with his presentation. We'll take presentation, just either presentations or brief remarks from all five of them to begin, and then we'll get into a Q&A. So Chetan, if you can just go ahead and start, that'd be great.
Okay, thank you very much to the CII for inviting me, and hello everybody. This draws on recent work with Piali and Shubhadeep, so it's about the evolution of Indian public debt. This was the topic today, which is inflation and public debt, so I'm going to take that title seriously and led some research to it. The focus is on fiscal dominance. So we know in COVID, different countries had different amounts of fiscal and monetary policy space to deal with the shock. Some countries had more fiscal space than others. India had limited fiscal space. And there's also this big discussion about how debt to GDP ratios are petered down by inflation. And there are reasonable views on this. That, some amount of inflation is always good to reduce debt to GDP. But once you are in an inflation targeting regime, the question becomes, inflation no longer becomes the ways through which you can deflate away your debt. So are there other avenues of fiscal dominance that play out? And so we want to use the Indian public debt data to see what these other avenues are for fiscal dominance. And fiscal dominance here is going to mean that countries come in, they enact an expansionary fiscal policy, and the central bank is concerned about interest rate costs, so they try to keep the interest rate low. But the perspective I want to lend on this exercise is that it's important now for us to think about debt management, monetary policy, and fiscal policy jointly. They're no longer things we can treat in silos. Those are things that we need to treat jointly. So here's a little Venn diagram. Sorry about this early in the morning. So the left part of the circle is the fiscal authority and how much government spending it does. The more government spending the fiscal authority does, the more debt the economy accumulates, the less fiscal space there is, and therefore bigger the scope for fiscal dominance. So you enlarge the left circle, you'll get a bigger bluish circle in the middle. The right-hand side is what the monetary authority does. It will try and keep interest rates low, either through asset purchases, financial repression, other tools. And then the debt management office is going to vary the maturity structure of debt. So all those three things are going to determine the scope of fiscal dominance. And what we want to argue in this work is that inflation becomes one less way through which fiscal dominance can happen. Another way through which it can happen is by changing the average maturity of public debt. So this is the evolution of general government public debt for India. This is between 1951 and 2018. So this is dated to 2018. We've just updated it to 2022. This is center plus state. So you can see that it kind of ranges from about 18% around independence. 2017, this was about 55%. Okay, this is items on the consolidated fund, not on the public account, right? So that's how we measure fiscal public debt. And this is with total liabilities. So if you see the blue line, the dark blue line, that's a notch higher because it takes into account the items on the public account. So again, here it ranges from about 22% at independence, and it's gone to about 75%. So this is the number that we hear about in the media a lot. about debt being roughly, having gone up from 60 to 80 and so on to 90 and then now bringing that back down. So you have to distinguish between items on the consolidated fund and items also on the public account. The government budget constraint, once again, apologies for putting some algebra here, allows you to decompose the change in public debt across any two time periods via the nominal interest rate, inflation, growth, and the primary deficit. That's that equation at the bottom. And when you do it for India, what we find is that look at this column here, inflation, which is this column over here. Inflation is more or less the biggest number. In other words, the negative sign means that inflation is reducing public debt. So take, let's say, 1963 to 1972. Starting amount of public debt was 32.4%. Ending amount was 39%. The change was 6.6% in that year. 20.4% of the reduction in debt, it increased, but 20.4% of the reduction in debt came by inflation, and so on. So when you do the decomposition, you see that inflation is the biggest factor, more or less, for declining public debt, and then there are other factors that are raising it, like the primary deficit. Okay? So that's what the decomposition tells us. If you look at India's high growth years, from 1999 to 2008, starting public debt to GDP is 32.5%, ending public debt is 51%, so that's a positive change in 19.2%. And here growth, of course, in those years was very high, so it led to a reduction in public debt by minus 33%, but then there were other things that led to an increase, so overall there was an increase. So inflation is the biggest factor that is mitigating debt to GDP. Now, when you look at 2014 to 2018, look at the last column over here, inflation becomes a lower factor in reducing public debt. Take 2014 as the de facto year of adoption of flexible inflation targeting. Inflation targets are not formally part of the central bank's mandate, but discussion is on, the Urjit Patel report committee has been submitted, and a glide path has been announced. It's coming. There's anticipation effects. And what you see here is, sorry about that, you see that the decline in debt due to inflation gets mitigated. So the question is, how else did the central bank manage its interest rate costs on public debt? So the way to do this is to use Hall and Sargent, which we apply. So I'll just give you a brief schematic representation of this. We have all the central securities issued by the center from 2000 onwards. Okay? We break these into zero coupon bonds. We have the principal and coupon payments, so we can get the total payments. We multiply this by the yield to maturities, and we can track the market value of debt. So now in this analysis, what we do is we're able to find the change in debt also as a function of the maturity structure of debt. And when we do that, we find that the nominal returns on marketable debt are the highest. Okay, so take this period from 2000 to 2022. This is again central securities. Okay, not total, not aggregate, and only items on the consolidated fund. Central securities debt is 19.7% of GDP. Ending 2022, just now, 47.7. So there's a change of about 28%. This positive change of 28%. 57% of this 28% was driven by nominal returns. Nominal returns became a big factor in raising this public debt. Inflation, of course, is negative. It's quite big because this captures the high inflation years from 9 to 14 and so on. Now, what's important here is that because you have the total yield to maturities, you can break down the total yield between the safe rate, the 1 year, and the term premium. So this analysis here allows us to show what was the contribution of the safe rate and the term premium in driving changes in public debt during this period. So the safe rate, remember the safe rate is the one that responds to monetary policy. So if it's high, then presumably monetary policy is tight, and then that's leading to a high nominal return, which is then driving the change in public debt. And then in the last row, you have these numbers for the primary deficit. Again, in the 2022 period, it's quite high, it's 29.4. So that's leading to a positive change in public debt. So let me end by giving you 3 pictures, and this is very tentative, but I'll put these out anyway. If you look at the average maturity structure of Indian public debt, it's been roughly constant, right? So this is this green line here, and it varies between 5 to 6%. And if you look at the 1-year safe rate, 365 T-bill rail, it's been moving around like the blue line is, okay? So what this suggests is that as the central bank has been cutting rates, and this is from about 14, there have been periods when it's gone up slightly, but it's kind of on this trajectory over here, the average maturity of Indian public debt has stayed sticky. and hovered between 5 and 6%. And what that suggests is that market participants may think that as the central bank cuts rates, they either may think that the central bank is credibly going to meet its inflation target or not credibly meet its inflation target. And if they think that they're credibly going to meet their inflation target, they may require a lower term premium in demanding higher issue security. So you're going to get the debt management office be more likely to issue longer term debt because they can do this at a lower term premium. When you do the same exercise between the fiscal deficit and as a percentage of GDP, not the primary deficit, the fiscal deficit is a percentage of GDP, and average maturity, so that black line continues to be average maturity, this is the fiscal deficit, you find that the correlation is minus, but it's not significant. But this picture is more revealing, which says that the longer, more higher public debt is, the longer is the extension by the debt management office, in raising the average maturity structure of debt, because you want to spread out the fiscal costs of public debt over time. So you want to minimize rollover risk. So what we're arguing in this paper is that the average maturity of debt could be an independent tool used by the debt management office to control the interest costs of public debt. And what seems to be suggested here, and again, these are correlations, but this is not a hard causation analysis, is that there's a lengthening of the average maturity structure of debt, and that may be the avenue through which we see fiscal dominance now because we're constrained by inflation target. Thank you.
Great. Thanks so much, Chetan. It was great. Sajid, would you go up next?
Good morning, and thank you very much for having me. Chetan's given you a wonderful macro lesson, so I'm going to talk more in the here and the now. We began 2022 with an R word. It was called reflation. Right? This was before the war. People thought this would be the year where growth picks up and inflation picks up. By the middle of the year, we used another R word. It was recession, and there was a real concern that the global economy was going to slide quickly into recession, given the sequence of adverse supply shocks that we saw over in the previous 12 months. But I would, venture to say that we're ending the year with another R word, which is resilience for the global economy. And why am I saying that? Because just think of what's happened in the last 12 months, right? We've had the strongest global inflation in 50 years around the world. We've had the most aggressive and synchronized monetary tightening cycle in 40 years. We've had, for much of this year, the strongest US dollar in 20 years. And we've had, what's less appreciated, is the weakest Chinese growth in about 46 years, barring the year of the pandemic. Right? Now, in a normal year, two of these shocks would have been enough to tip the global economy into recession. We've had 4 such shocks, and we're still standing. Growth for 2022 globally is expected to average 3%. The US economy in this quarter is tracking 1.5%. In fact, consumption and investment have been accelerating in the fourth quarter in the US. Right? So we must appreciate that given all the recession risks next year, and I'll talk about that, the fact is there's been a lot of resilience that's been shown in the global economy this year. Why? Because this crisis was always different. Because the private sector and advanced economies came into this crisis with much stronger balance sheets. US households had $2.7 trillion of excess saving this year. Corporates had come on the back of record profits in the last 2 years. And these strong balance sheets have allowed private sectors around the world to absorb these shocks and not tip the global economy into recession. So that's the good news. Now, add to that the fact that inflation is coming down, oil is back at 75, the US dollar has depreciated by 10%, and this would seem like this is a Cinderella outcome, right? This is a soft landing. We should all pack up and go home, and I would have ended in that to say, but in fact, we're in this crazy world where good news is bad news and bad news is good news, and the good news I've laid out is actually not very good. Why do I say that? The resilience of the US economy, for example, has meant the labor market's red hot tight. We had a jobs number that came out last Friday night where wages were still running at 7% on an annualized basis. And this is a year with among the lowest recorded productivity growth in the US. So from a firm's perspective, you've got wages running at 6-7%, you've got productivity growth slowing, which means unit labor costs are rising even further. And 6% wage growth is just not compatible with 2% US inflation. And that's perhaps the most important variable to track in the coming months, that the Fed is not going to be comfortable at these dynamics. They're going to have to raise rates perhaps more than we think to slow the labor market down, bring wage growth down, so that they have more conviction that they're getting closer to their 2% inflation target. So in fact, with every month that the labor market remains hot, the odds that the Fed has to do more and remain elevated for longer grows, which then means the prospects for growth next year around the world, 2023, 2024, are lower, and the prospect of a soft landing recedes, and a central bank engineered recession around the world actually rises. And the concern for emerging markets in 2023 is going to be, even in a benign scenario like what JP Morgan forecasts, where global growth slows to 1.5%. So growth globally was 6% last year, 3% this year. Even in the benign case, it's 1.5% next year. You won't have a Fed that's cutting interest rates. And I think that's the key point to realize, that 2022 became difficult because the old correlations broke down. Normally, when you have a strong dollar, you have weak commodity prices. When you have high commodity prices, you have a weak dollar. And as a commodity importer like India, you get a natural hedge. If oil is high and your current account's under pressure, the dollar tends to be weaker and you get help on your capital account, and vice versa. But it became a difficult year because you had both higher oil and a stronger dollar. Now, 23 could be a difficult year for emerging markets because you could have slowing growth and yet very tight global financial conditions. So this was a long introduction to say that we're not out of the woods yet. Emerging markets are not out of the woods yet. 2023 could be a tricky year because of a slowdown, because interest rates will still remain elevated, because the world hasn't seen US rates at 5% in 25 years. And there's a real chance that something somewhere may actually break around the world. We saw it with the UK pension system. We saw it with crypto. We're seeing it with some real estate funds. So we need to be extremely wary. What does all this mean for India? I think we have to look at India from 3 different horizons: a 9 to 12 month horizon, a 2 to 3 year horizon, a 5 to 7 year horizon. I think the 9 to 12 month horizon has to be double down on macroeconomic stability, right? Exactly like what we've done in the last 6 months, that this could still be a very dangerous world, and we want to make sure that imbalances have come down. I guess the key variable, and everybody in this room is aware of this, is the current account deficit. And this is understandable when you've got such a large terms of trade shock with oil and other commodities moving up. India's current account has widened. The IMF estimates about 3.5% of GDP this year. And one focus will have to be, if you're in a difficult world next year, you want to bring that current account deficit down. Now, Chetan spoke about fiscal in a bit and government debt. I want to just link fiscal deficits with current account deficits, because on a more fundamental basis, I'm going to avoid being too technical. The current account deficit is simply the investment savings gap of an economy, which is therefore the sum of the consolidated fiscal deficit, which is the investment savings gap of the public sector, and the investment savings gap of the private sector. And to the extent that, so why did we have a situation where the fiscal increased in the pandemic year as it did around the world, but the current account remained contained? Because the private sector savings went up, private sector investment came down because we couldn't spend in the lockdown. And so large fiscal deficits did not translate into higher current account deficits. They were absorbed by the private sector. But now things are changing. The private sector is recovering nicely in India. Savings have come down, investment is going up, and so the fiscal automatically spills over into the current account. So if you want to bring the current account deficit down, and we want the private sector to flourish, for savings to come down and investment to keep rising, the fiscal will have to keep consolidating away. I think the government has a very sensible plan to reduce it by 2% of GDP, and I think that becomes important. The second instrument here has to be the exchange rate. That if we want to bring the current account deficit down, but we don't want growth to slow too much, we don't want to choke imports, you want the exchange rate to become a shock absorber. A weaker currency makes imports more expensive. It increases the the chance that people will move to domestic substitutes. A weaker currency in trade weighted terms makes exports more competitive. So you want to have both expenditure compression, but expenditure switching, right? And you want the weaker currency to help you bring the current account deficit down. And the third element here will have to be focusing, on inflation expectations, which the central bank has done commendably over the last 6 months. So, short point is, over the next 9 to 12 months, the focus will have to continue to be macroeconomic stability. And to the extent that there are renewed global pressures, these will have to be absorbed across multiple instruments. You don't want to overload any one instrument. You want to use reserves judiciously. You want to ensure that the exchange rate becomes a shock absorber. You want to ensure that fiscal takes some of the pressure of the current account. And you want to make sure that monetary policy keeps inflation and inflation expectations very anchored, right? And so we'll just need to be patient to get through this global storm. Now, if we can get through this global storm, which I have no doubt we can, the next 2 to 3 years looks, in fact, incredibly constructive. For 10 years, we've been debating on stages like this, the twin balance sheet problem, right? That corporates had large levels of debt, banks had large levels of NPA, nobody was lending, nobody was borrowing. That's changed. That there's been significant deleveraging over the last 5 years. Corporate debt to GDP is the lowest, as you will know, since 2006. Balance sheets are looking better than they have in a very long time. Both corporate balance sheets and bank balance sheets. And the fact that credit growth is picking up is testimony to that. But again, we need to be patient for an investment cycle, because utilization rates are still somewhere between 75 and 80 in a world where you worry about a global recession, rates are moving up, there's so much macro uncertainty. It's understandable that entrepreneurs in India will take a little time, right? So the investment cycle may well be pushed out a few quarters, but at least the preconditions are falling into place. This is where I think the government's sustained push on infrastructure becomes so important. That we've seen a big push by the central government. It's important that state governments and PSUs follow suit and complement the government's efforts, because a big push on infrastructure does what? It increases aggregate demand if the private sector isn't investing. It helps the private sector increase utilization rates. It creates blue-collar jobs to compensate for some of the scarring in the pandemic, and it makes India more competitive in the medium term. So I think over the next 2-3 years, the good news is if we can get through this global hump in the next 12 months, balance sheets are looking better. If the infrastructure push can continue, that lays the groundwork for a private investment cycle 6, 8, 10 quarters from now. Very quickly on the thing, I spoke about the need to consolidate the deficit, and I'm speaking about the need to do more infrastructure spending. How do you reconcile this? You need more tax to GDP. You need more revenues. You need more asset sales. This is where I think the GST is showing much promise, but we'll need to do continuing tax reform in the coming years so that tax to GDP goes up, asset sales go up, and you can do both things. Reduce the deficit for macro stability, but keep doing infrastructure spending for growth. Finally, what's the 5 to 7 year horizon? Well, the geopolitics on paper look troubling, right? More protectionism, more deglobalization, more economic balkanization. But within that is a unique geopolitical opportunity for India. All of you have heard about China plus one and friend shoring. What's less appreciated, and I'll end with a couple of final thoughts, is that China is vacating large amounts of space in low-scaled, unskilled, labor-intensive manufacturing. Textiles, shoes, leather, ceramics, furniture, right? And over the next 10 years, as the Chinese workforce shrinks, right, and China moves towards more high-tech exports, a lot of this space globally is going to become available. And India really needs to fill this vacuum. Because given our demography, we're going to have tens of millions of blue-collar workers coming into the labor force. So what you want is labor-intensive manufacturing that will create those jobs. The services sector is doing fine. Our global share of services has been rising secularly the last 5 years, but those are white-collar jobs. The focus will have to be on occupying this space in the export front, labor-intensive exports, to create the blue-collar jobs. Exports are key because of a very simple empirical regularity. No country in the world has grown at 7 to 8% for a decade without strong export growth. And so India will have to pursue that policy, and the geopolitics over the next decade becomes very favorable. So let me end by saying we should look at India in these horizons. The next 9 to 12 months, buckle down, hunker down, get through the global storm, focus on macro stability. On the other side of this, the prospects of a private investment cycle appear bright, helped by government capex and tax reform. And then we have to keep doing all the reforms, land, labor, power, financial sector, to capture this unique China opportunity. I'll end with a cricket analogy. My favorite batsman used to be Sunil Gavaskar, who used to say, on a green wicket, the first hour belongs to the bowler. Get through the first hour, the next 5 hours belong to the batsman. I think that's the stride that India must pursue. Thank you.
Thanks, Sajid. I like the optimism. Taimur, over to you.
Thank you very much. Good morning, everybody. Pleasure to be in Delhi. I would take some of the points made by Chetan Ghate and Sajid Chino and expand on them. You heard Chetan talk about the government debt drivers from inflation growth perspective. You heard Sajid talk about the global environment for next year becoming a bit more adverse because the Fed will not be able to cut interest rates. So let's take those things and think about it from a more international perspective, how India scores from a EM scorecard perspective. So first, the issue of interest rates. So I concur with Sajid and JP Morgan's view that the Federal Reserve will have a very hard time cutting interest rates next year, even if growth slows, even if inflation comes down, because we have all these underlying drivers of wage growth and labor market dynamic, which would make the Fed uncomfortable about cutting rates, because the risk then would be to undermine inflation expectations and allowing it to come back again. So next year, globally, India, US, wherever you see, there will be disinflation. It just will not be sufficient disinflation. But this is a very problematic story then. We will have nominal interest rates unchanged. We will have inflation come down, not enough for the Fed to cut, but coming down a lot, meaning real interest rates will go up substantially next year. For all the shock that we experienced in the global economy this year, from the war to the pandemic to the rise in inflation, as well as the Fed raising rates substantially, real rates have by and large been negative or zero. Next year, whether it is in India or in the US, real rates will turn positive with a vengeance. I estimate real interest rates to go up by at least 200 basis points, both in the US and India next year. And this is not just an esoteric discussion about debt dynamic, it is something that matters to the bottom line of all companies. Your debt service cost relative to your revenue growth, revenue to your bottom line, will become more adverse in 2023. And around that, we will see greater distress and surfacing of vulnerabilities that were under the wraps this year because high inflation, the base effect that comes from nominal growth, masking a lot of that. We will not have that luxury next year, so watch out for that interest rate shock. It will not be nominal interest rate shock, it'll be real interest rate shock next year. You saw in Chetan's slides, or maybe he went over it so fast that only those who sort of think about debt dynamic equation saw it, is that when you break down the drivers of growth, you have to think about the interest rate, the primary surplus, the underlying growth. But the interest rate is the real interest rate. You can inflate away a lot of debt, as you saw on Chetan's slides, that in the past, when India used to be a high inflation economy and exercise some degree of financial repression, real rates were always negative. So it didn't really matter if at the central government level or the consolidated level, debt GDP ratio was pretty high. It all got taken care of by inflation over time. But now that we have an RBI over the last decade or so becoming more and more serious about tackling inflation, that little freebie that we had from inflation eating away debt is evaporating, and the going would be tougher if indeed the government remains serious about macroeconomic stabilization. So that's issue number one. 2023, higher real interest rates, both in emerging markets and in developed markets. And around that, one should be girding oneself for some degree of corporate distress. Second, you heard from Chetan a discussion on India's public debt. Of course, there is other debt, and you heard Sajid talk about it a bit, that debt GDP ratios with respect to the corporate sector has improved over the last decade. But the fact of the matter is, India is a large debtor nation. Large public sector debt, large corporate sector debt, and increasingly rising household debt. When you add it all up, it's not just a question of the rupee debt, there's also a very big question of the dollar debt. 600 billion plus India's external debt as we speak. So I work for DBS. I sit in Singapore. We have operations in ASEAN, China, India. So when I look at a matrix of countries, the metric that I use to understand their vulnerability for the coming year is what we call gross external funding requirement. So we don't focus on the domestic debt funding requirement. We talk about the external debt funding requirement. What does the public sector plus the corporate sector have due next year in dollar terms? What is the current account balance in dollar terms? Add it up, that's your gross external funding. And the way to scale that is to basically scale it by reserve. So always from a macroeconomic surveillance perspective, from a bank risk assessment perspective, it's the amount of funding you need next year in dollar terms relative to how much reserve your central bank has. 9 years ago, 2013, taper tantrum, at that time, we saw many emerging market countries see their exchange rates come under a lot of pressure, their debt coming under a lot of pressure, yields going up, because the global markets were very concerned about a possible rise in US interest rates having a destabilizing impact on the funding of various emerging market economies. You may recall, if you were involved in the industry in those days, we were talking about the fragile five economies, and a fair number of countries in Asia were part of that. Thankfully, we are sort of past that critical risk period, that Asian economies, by and large, India included, are not seen as acutely vulnerable from the perspective of a global portfolio manager. But at the same time, when you think about that metric, gross external funding requirement, who looks good and who looks relatively not so good in Asia with 2023 in mind? At the top of the ranking would be the North Asians, Korea, Taiwan, strong exports base, strong savings, strong reserves. So even if rates go high next year, even if the dollar remains stubbornly strong, doesn't matter. Their corporate sector will be able to tap into substantial domestic hard currency reserves to take care of their debt. And you see that in the pricing in the market, the spreads of their corporations, the spreads, the credit default swap on their public sector debt, nothing looks worrisome or ominous. China used to be in that group. Extremely strong cover because they had multi-trillion-dollar reserves, running burgeoning capital account and current account surplus. China remains in comfortable territory, but not the way it was in 2013. It has lost a lot of reserves, and its external financing are not as strong as they used to be. But still, on a relative basis, China, Korea, Taiwan, in a total different league. Nobody worries about their running out of dollars. Who's at the bottom of the ranking? Indonesia, Malaysia, and India. So we talk a lot about how over the last 4 or 5 years, RBI has, intervened in the market and built up a war chest. Unfortunately, the size of the current account and the amount of debt the India's corporate sector has due in dollar terms, they haven't come down sufficiently to make that ratio get much, much better. So India doesn't look any worse than it was in 2013, but on a relative basis, it is still in that club of India, Indonesia, Malaysia at the bottom of the ranking as far as external funding requirement is concerned. So 2023, we would need some softening in the global economy, but not too much, so that exports get harmed in a very bad way, but imports remain stagnant or stubbornly high. We also would need interest rates to not skyrocket. So, you heard Sajid talk about the possibility that the Fed may have to go higher than what the market expects. That would be unambiguously bad news for all of us in the emerging markets. So let's hope and pray that doesn't happen. But those risks are things that we have to be cognizant about. What are the silver linings? How could we get bailed out next year? If inflation doesn't come down sufficiently, well, that adds some degree of that debt dynamic mitigation. It helps erode the base effect on debt GDP ratio. If we see China come out strongly after this year's debacle around COVID and 3 red line and common prosperity, maybe that becomes a source of demand and a stabilizing, balancing factor for the global economy. And perhaps, if indeed the dollar turns the way it has in the last 3 to 4 weeks and continues that trend, maybe that becomes a source of breathing room for emerging markets. But lots of ifs and buts, so watch out. It could be a bumpy ride. Thank you very much.
Thanks, Taimur. Amelia, over to you. I think Taimur is kind of balancing out Sajid's kind of optimism here, but I think, and a bit of a scary prognosis for some of us in the lending business. But I think it's a useful set of points. Thank you.
Thank you very much. Good morning. So after this a bit scary discussion, maybe I'll bring some more positive light into the discussion. And I agree with many speakers before me. But I think we'll present a little bit different perspective, maybe much broader perspective than few emerging economies. There are a few slides that would actually show some of the trends that have been discussed before. Of course, we see, so the whole presentation will be about India resilience today and what India needs to do to strengthen further the resilience and continue to sustain very robust growth. My colleagues mentioned that oil prices has increased tremendously. It was also followed by the food prices, which is shown on the chart. And as a result, inflation has increased in emerging economies, but also very importantly in advanced economies. So we are also seeing this monetary policy tightening, a big shock to the global economy, emerging markets, and advanced economies. We see that monetary policy tightening is much higher in more advanced economies than emerging economies, but they started from the much lower level. And of course, we're always following the news that every second month we see the growth projections being reduced, and basically maybe not as much this year as we expected, but as we expect, this is not the end of the story. The next year is going to be also very, very tough. So how India has been reacted to some of these, what we say, unfavorable growth and interest rate shocks, including oil shock. We have done a little analysis on the how some of these shocks affects India vis-a-vis other emerging economies. We took into account 23 emerging economies, and we see that for India, the spillovers from the US growth slowdown, China, and emerging and advanced economies is a bit smaller than for other emerging economies. So India is much more resilient to these shocks. 1 percentage point in decrease in the US GDP growth will result in 0.4 percentage point decrease in India. Similar size of the shock would affect India from the euro area, 1 percentage point decline of growth. And if you see other emerging markets, the shock has much bigger impact, almost twice bigger. So then the question is why India looks more resilient than other emerging economies. And if we think about overall framework for resilience, we discussed many of those elements before. We looked at the vulnerabilities, actually how country is able to absorb the shock, how fast the country recovers, and of course, going forward, what is the country growth potential in the long term. So it seems that India has been doing pretty well in both in terms of reducing vulnerabilities, shock absorption, and also, as we have seen after the COVID-19 recovery of growth. We look again at the emerging economies, the broad group, a bit around 20 emerging economies, and without getting into details and the figures, we look at the indicators of the external vulnerabilities on the macro financial stability, external environment, and market perception of country risk, and we compared how India compared to other emerging economies before the taper tantrum and what India looks today. And of course, this is relative, but you can also compare India between now and in 2013, and we see that the colors from red move to yellow and green. Of course, what Chetan was pointing, there are some reds, and it concerns the public finance, mostly budget balance to GDP. It's high. We know also that public debt is high, but it's still the increase in relative to other emerging economies was not as high, so India remains in yellow. There are some still scope to improve in terms of the corporate debt or the financial sector stability, but overall it seems like India has strengthened or reduced the vulnerabilities compared to other emerging economies. And here I would say I will be more optimistic than my previous speaker, because as we see external debt, actually, and short-term external debt to reserves looks much better in India than other emerging economies. So on that indicator, we have not been too worried so much. If we look at the current account deficit, it's also in yellow, so it means that it's not the best performer, but actually it's pretty well financed. We have seen that FDI inflows in India have been pretty robust, and the financing side look much better than in many other emerging economies. So what I would turn now to, after discussing a little bit the vulnerabilities and the shock absorption, because the shock absorption also come from the buffers that India had, and some of them has been discussed, high reserves, still fiscal space to respond, and monetary space to respond. One can also think what would be after those shocks passes, and we would think about long-term development of India. We have looked at the potential growth, and it seems to be again comparing favorably to many emerging economies. The growth of India last 2 decades was around 6.5, 6.8%. And we know that it has been driven by very strong productivity growth, total factor productivity. And you see, even in compared to China and many countries in the region, it has been much higher than elsewhere. However, if you look at the level of the productivity and compare it to the high-income countries, because India aims high, want to become high-income economy in 2047, there is still much to be done in terms of labor productivity in almost all major sectors. I will not go to all these details, but what we do now in the bank, we're working on the long-term growth trajectory for India and what are the structural constraints, and some of them are mentioned in that slide. However, I want to put more emphasis not only on the how robust growth will be, how to further strengthen productivity, competitiveness, economic dynamism, but also what is super important for us in the bank is looking at the quality of growth. So both social and environmental quality, we can discuss this more, and I hope to have a chance to present to you finalized analysis in few months, but it is very important looking forward to see what is the progress in education, healthcare, sanitation, and social infrastructure that India made, how to strengthen federalism and social mobility, and very importantly, how to increase female labor force participation, which would have important impact for social quality. On environmental quality, we know that India is one of the countries that is most impacted by the climate shocks, and from that perspective, it's very important to decouple growth from the pollution, not for the world, but mostly for India. Less polluted or less fossil fuel dependent world would also benefit India, because the shocks are affecting country tremendously. I'll not go to the natural capital, etc., but these are all the factors that we are looking at in terms of further developments of India and strengthening potential growth. So in summary, I want to point to these main areas. So we see that vulnerabilities has been reduced for India. Still are a few areas that I mentioned that require further strengthening. One is the high level of debt, absorption capacity. Again, we can say that health of financial sector is very important. Here, the improvement has been made, but policy buffers has been declining, and it's important to build them in the recovery phase. I haven't discussed this a lot, but what is also very, very important is not only how much the public sector is going to support investment, but it's also very important that India has this flexibility to reallocate resources. So product market, institutional labor market reforms that India have started, it all concerns doing business and labor laws that are being under preparation. The more flexibility is very important, because in the shock, economy needs these reallocation capabilities. And going forward, To strengthen the productivity growth, I haven't discussed details here, but in the bank we're looking how to complete the structural transformation, mostly to increase productivity in agriculture, sustain very strong productivity in service sector that has been benefiting India tremendously, and support further private investment. On social quality, India has started and is doing very well on digitalization that is already reducing informality, further increase or making more efforts to increase female labor force participation and strengthen federalism, which could incentivize set up deliver of public services. And finally, on environmental quality, we all know that if India have done tremendous progress in moving to the renewables, but getting to in long term to net zero would require investment in clean technology and some of the technologies that do not exist today, further strengthening green investment on the private and public side, and finally, don't forget about just transition support. Thank you.
Thanks so much, Amelia, for that outside-in view. Neelkant, over to you.
Pleasure to be speaking to you. Let me start the timer. So one of the challenges of speaking after four excellent speakers is that you need to add on to what has been said or disagree if you need to. So I'll focus on five things. The first, I think both Sajid and Taimur talked about, which is the external environment and the strength of the dollar. My own view is that even though the trade-weighted dollar has depreciated in the last couple of weeks, I don't think we are done yet with dollar strength or the concerns around the dollar. And the most important issue here is, as they also said, the duration for which interest rates remain high. There is a lot of obsession in the current commentary on what the peak rate will be. So as we start to get closer to the peak rate, I think the next concern would be how long the rates remain high, because the concern will be that as loans come up for repayment, the companies and individuals will find it harder and harder to justify paying much higher rates. And given that concern, I think the risk of dollar shortages emerging again next year would be quite high. Once that starts to happen, in fact, the other day I heard from a peer that in all of the first half of next year, there is $0 bond issuance in all of Africa. In fact, if you talk to companies, and I'm sure some of you here would have experienced that as well, that if your dollar bonds are coming up for repayment next year, it's going to be very hard to find sort of commensurate rates or easy rates at which to borrow in order to pay that. So very likely that individuals and companies will think of repaying their dollar debt, in effect increasing the demand for dollars. The second aspect here is the slowdown in growth. The dollar is also considered to be the safest currency. Whether it should be or not is a different debate. But if everyone believes it is the safest currency, then it remains the safest currency. And whenever there is a problem with growth, so as the growth slowdown really starts to bite, so you saw the first glimpse of that a couple of days back when we saw China's exports numbers weaken, where the world really starts to worry about the impact of slower growth. And while India is, I think, slightly less impacted, our export dependency is lower, though, of course, over the next decade, we need to get it higher. I have some ideas on that. But I think the challenge for the rest of the world is going to be, in a slowing growth environment, finding dollars to repay. And as that happens, and as risk appetite falls, it will become what we call the money multiplier. The credit creation in dollars, I think, starts to come down further. And given the high inflation in the US, the demand for dollars is anyway going to keep going up at a time when there is quantitative tightening. And I think the concerns on a potential accident happening in the global financial environment, even though all of us are expecting it, is something that we need to plan around. The second big issue I must talk about, as the chair of this session asked me to, is the prospects for emerging markets. I think most emerging markets are dependent on external demand. There are very few like India and Indonesia which have slightly more dependence on domestic economy. China is becoming slightly more domestically dependent. But I think the important issue here is that for China as well, I mean, Chinese demand, consumption demand has been very weak. In fact, Chinese real estate markets look very uncertain. In fact, there's a lot of work done by the government. There's possibly more work happening, more policy steps being taken in the next week or 10 days to ease the supply of credit to developers and all that. But I think the challenge for China is going to be real estate demand. Next year, their local government financing comes under stress again, and the potential for infrastructure investment comes down as well. And this is on top of the fact that Chinese consumption demand, which is now very large. Just for perspective, Chinese retail sales are now 2/3 of US retail sales. So on a per capita level, they are much lower, but as a contributor to global demand, now they are right up there. And so if the Chinese consumer remains weak, even after the relaxation of the COVID pandemic, the COVID restrictions, I think that's a very big problem for all of emerging markets as well. The third is coming to the topic on inflation. I think the inflationary drivers are easing. In fact, as supply responds, so one of the surprising changes, not surprising really, but I would say the incremental changes in the last couple of weeks has been easing of further supply restrictions, even in India. We have also seen crude oil come down to the 7 handle. So it's a sign that as the world starts to slow down, some of the inflationary pressures will come off. We need to be very careful, though, in extrapolating this to lower dollar funding costs, because what matters for the US is now services inflation more than goods inflation. So goods inflation is easily transmissible. The cost of a DRAM chip is the same in the US as it is in India. The cost of a taxi ride, if it goes up in the US, doesn't really affect us directly. Now, the Fed will still be fighting services inflation in the US, whereas inflationary pressures in most of our part of the world will start to come off. In fact, those of you who do your vegetable shopping yourself would have been surprised by how sharply the prices have fallen. Some of it is seasonal, but the decline is quite striking. So I think inflation will be less of an issue in the next year or so. But I think we need to focus on the next point, which is our what is a binding constraint in the search for dollars. Now, if you see crude oil prices falling by about $20 a barrel, so most people had expected $100 a barrel for the next year. Now, suppose you take 80 a barrel. Every dollar per barrel is about $1.5 billion a year. So we gain about $30 billion on a 12-month basis. But remember that if your exports are falling off by 8 or 10%, that's a $40 billion drop, right? So from a $440 billion base, you see a sharp reduction. What is perhaps going to be a bigger issue is on the capital account, because of our current account deficit, we are perpetually in need of dollars from outside. When there is an accident, when there is high risk aversion in the global markets, capital flows start to slow down. And I think that creates significant risks for India as well. Now, the lesson for us, therefore, is, I think Sajid mentioned this as well, that try to focus on stability. In fact, the very visual example I'll give is that if you're forced to slow down, so suppose there's a global accident and you are forced to slow the economy down very sharply. As we all know, if you're going at 100 kilometers an hour and you have to stop in 50 meters, it is very hard to do that without breaking someone's bones. But if you're going at 60 kilometers an hour and you have to stop in that, so people will be a bit jittery, it will be uncomfortable, but no lasting damage. And once you've crossed that hump, you can start accelerating again. And I think that has to be the policy prescription. One last point, the fifth one, and then I'll stop, which is we have about 30 years to grow fast so that we do not grow old before we become rich. Right? So there is a very real risk of China and Thailand and some other countries which are aging really rapidly, and perhaps faster than their economic growth. And there's a very real risk that they will grow old before they become rich. Our average age is projected to cross 40 in 2053, so we have about 3 decades to solve that problem. We need to grow at 8 to 9%, if not faster, in order to reach $25,000 per capita GDP. If we do not, if we keep growing at even 7%, I don't think there is. Then we will still be a middle income country, and after that, then it becomes harder and harder to grow. Uh, what do we need to do that? We need to attract much more capital. We need to attract a lot of FDI. We need to be a lot more accepting of foreign expertise. And there are a whole host of changes that perhaps need to be done, improving the tax treatment for tolling, what we call, when a foreign company brings goods in here, converts it and then re-exports it. Vietnam, which is doing so well in exports, a large part of their exports are actually tolling. Till you get good clarity on some such things on a policy perspective, it's going to be very hard to accelerate growth. But I must say that the signs on these fronts are very positive. In fact, I'll close on a slightly more positive note. In fact, I'm the most currently, other than the external risks that I talked about, from a domestic drivers of growth perspective, I am the most positive I have been in all my years of tracking India's economy on our medium-term growth prospects. On that count, I'll stop. Thank you.
Thanks, Neelkant. I think I really like the balanced view that we've got across the panel here, kind of, from all five participants. Given that we've got predominantly industry participants here today, I'm going to first ask the five of you kind of an industry question that faces kind of Indian industry today, and then turn it over to the audience. So we've got for questions, and if they don't, we've got a couple of questions we will ask. Basically, like a couple of you alluded, to corporate balance sheets have really deleveraged, right? Most people are either sitting on cash or kind of very deleveraged balance sheets. And the question, actually, if you kind of to go across, I think Indian industry in general is much more optimistic about the next medium to long term than it's ever been before. That's reflected in credit offtakes for banks, like you all know, has been kind of up 18% this year. And so the real question I have for you is, given that some of you had a more bullish view, some of you had a slightly more cautious view, do you think it's right that Indian industry now starts investing heavily in growth for ourselves? Which will obviously mean that we will start levering up our balance sheets more. Do you think that that's the right answer for the next couple of years? And if yes, then where should the market focus be? Should it be on the domestic market, or should it be on the Western markets or on the Asian markets? So it'd be good to get kind of just a quick read from each of you, and then perhaps we'll start off with you, Amelia, and then kind of get a quick read from each of you, and then we'll turn it over to the others for other questions as well.
So thank you. I will not answer whether to invest, because I think audience knows better than I. But certainly, what we see and what was clear from the presentation is, since we believe that India prospects of growth in the short to medium term are favorable, of course there is time to invest, and there is time to expect the returns. So to me the answer is clear, but of course where to, in domestic, which market, maybe I leave it to my other colleagues.
Yeah, no, I definitely think that there is a big opportunity to invest. In fact, one of the issues that is perhaps not as well highlighted, but it must, is the changing attitude of state governments. Sitting in Delhi, we seem to think that it's all about the central government. A lot of the incremental reforms need to happen at the state level. It is remarkable that there are state governments like Tamil Nadu, UP, Maharashtra, all of them have $1 trillion GDP targets. There are consultants who tell me that Karnataka is doing a lot of excellent work, Gujarat is doing a lot of good work, and even my home state of Bihar. I mean, we are still, a long, long way to go, but there is acceptance finally that you need private investment, you need capex, and I think this easing of the process of acquiring land, the better availability of energy, a much better infrastructure in terms of highways and railways. And I think even from the talent perspective, we have seen a 5x improvement in the percentage of adults about 25 who are in college or have been to college. So over the last 15, 20 years. So I think this is a good time to be investing. We need to be aware that in the next 12 months, we are going to see a lot of spare capacity globally. So depending on the industry you're investing in, just plan it out. It may be possible if we are fortunate to acquire capacity globally as well. On which market to focus on? I think there are all three markets. I would say there are three markets. There is a market for exports, there is a market for import substitution, and there is a market for catering to domestic demand. And I think all three over the next 10, 15 years look to be very attractive to me.
Thank you, Mr. Zubair. The reason I laid out these three horizons is because we need to be realistic about the near term, right? We have to kind of accept the fact that you're going to see a sharp deceleration in global growth. As Temur rightly said, real interest rates are going to go up. I agree with Emilia that we're perhaps less exposed from an export perspective, but as Nilkant alluded, exports were a huge driver of growth the last couple of years. Just to put some numbers on the table, we grew at 8.7% last year, 3.1 percentage points of that. That's 35% of growth came from exports, which are 20% of GDP. Now, in the last 6 months, understandably, as the global economy has slowed, the export contribution has come down. We need to be realistic about next year's growth prospects in India. If global growth at 1.5%, monetary policy, fiscal policy is tightening around the world, all emerging markets, including India, will have to kind of understand the implications for growth of that. So we need to be realistic. I think the preconditions for a capex cycle are clearly falling into place. But if you're worried about a global recession, US rates are at 5% and utilization rates at 75 to 80%, we may need to be patient. We need to be patient to see the next capex cycle, which is why in the interim period, it's so important for the government, central government and state governments to not let up on infrastructure investment. That public investment fills the gap until we're on the other side of this global hump, and then private investment slowly takes over. I'll add one more point. I'm less concerned and more agnostic about where the investment happens. I think all the fine people in this room are best positioned to make that decision, domestic, global, exports. My concern a little bit has been, if you look at the last 15 years, we're becoming more capital intensive in our production techniques. Look at our export basket. We've gone in the last 20 years from textile, leather, gems and jewelry to auto parts, engineering goods, pharmaceuticals, all up the value chain. We've become market leaders in some areas. But for an economy that's very young, where our demography over the next 30 years is going to have lots of young people coming into the labor force, the key is how do you make production more labor intensive? And that means from a policy perspective, how do you make labor more attractive as a factor of production? Because entrepreneurs vote with their feet. So I think the policy kind of challenge or imperative for the next few years has to be that we do the things from a policy perspective that make labor more attractive. That naturally means that entrepreneurs move towards more labor intensive industries, and then we create those jobs that we so desperately need, and we occupy the space that I mentioned globally that China has vacated. So I think that's more important than which industry we're in.
Yeah.
So if there's a lot of uncertainty, I think the option value of waiting will rise. So that's probably going to deter some investment. But taking a longer term view, if you look at breaking up India's growth over the last 40 years, from 1980 to about 2019-20, 60% of that growth has come from capital, 35% from labor, and 5% from total factor productivity. So as the gentleman was saying yesterday on the panel, that a lot of India's economic growth is driven by factor accumulation, capital and labor, and less by total factor productivity. Now look at the 2008 investment rates. 2008 investment rates were 37, 38%. Okay? Growth was roughly 8%. Okay? Investment rates now are about 30%, and growth is roughly 6.5%. So if you take the delta on investment rates, 38 minus 30, about 8%, as a percentage of, let's say, 40% investments, about 1/5, and you take 1/5 of growth, that's about 6.4, so 1.6 minus 8, you get 6.4. So investment rates are crucial for growth, and that 8% investment gap, just using a back of the envelope calculation, is something that will need to be filled to get growth rates high up to that mark. Now, the question is, do you fill that by public investment? Do you fill that by PPPs? Do you fill that by private investment? If you fill it by public investment, what's the implication for public debt? Does it crowd in private investment, and so on? Those are all important questions that need to be understood. But getting to that high growth will require filling that investment gap through some combination of all of these things. On exports, I think two of the anchors of thinking about growth and development internationally as well as domestically, we're coming off a period of hyperglobalization, and that's been playing into all kinds of other features of the economy, but also the domestic. So globalization is now maybe going to be seen as possibly less of a force for export growth, but even domestically, the model for growth was always that if you had export-led growth, then that would lead to structural transformation, that would absorb labor from the agricultural sector, and then you would get wages to rise and so on. And that channel is also growth. So the question is, what should be the growth model in this world? Now, if the export-led channel is mitigated by this reason, and if the hyperglobalization, we're coming off from a period of hyperglobalization, where does the growth come from? Does it come from services? If it comes from services, break up services between traditional services and modern services. Modern services are only going to absorb the given amount of human capital in the economy, right? Traditional services then becomes one engine for which growth should happen. But if traditional services becomes the engine through which growth is going to happen, that's not a great path to industrialization. Then you say, well, if manufacturing is not going to absorb the jobs that are going to be coming out of agriculture, maybe it's going to be the smaller, the MSME sector that is going to be the engine of job growth. I suspect that is where policy needs to concentrate. It needs to think about the MSME sector, needs to think about its role in global value chains, needs to think about public infrastructure investment, that 8% gap in terms of making this competitive in a global sense. Because that's going to be the numbers we have is roughly 6.3 MSME sectors. Most of them are micro, but roughly 11 crore, sorry, 6.3 and 11 crore employment, 110 million employment. So I think that's where the policy focus must be to make the growth employment intensive. It's going to require maybe not industrial policy because that has a bad name, but we always talk about picking champions in the formal manufacturing sector, but it's going to require some hard thinking on what to do in the MSME sector.
I will talk a little bit about vulnerabilities within industries. System-wide, the debt numbers don't look alarming, but then there are certain sectors in India which have added up quite a bit of debt in recent years and decades. So think about the technology sector, particularly tech services. A lot of enthusiasm, exuberance, and a lot of money has gone in. The harbinger of things to come is clear. Already in the US, you've seen substantial layoff in the tech services sector, and sooner or later that will translate into lower demand for tech services out of India. These are not inelastic industries, acyclical industries. They do go through cycles, and that is coming. And to the extent that we have seen a lot of exuberance and exceptionally high expectation of return on investment, there will be disappointments and there will be some debt-related distress. Is there substantial leverage on the property sector? There is leverage, no question about it. Is it going to be undermined by the fact that real interest rates are about to go up by 200 basis points? Probably to some extent as well. I think that we make that assertion that India is a low beta economy to our peril.
India is not a low beta economy. In fact, I think a lot of work done by Sajid and Jahangir Aziz at JP Morgan over the last decade has shown it repeatedly that the cyclical amplitude of India's economy actually mimics that of the global cycles. So it is not the case that while the rest of the world suffers, this area can be a cocoon of stability simply because there is a large domestic demand dynamic. It is not the case. The fact of the matter is, Indian industry's prospects do go up and down with global prospects. And so, 2023, if we're going to be in a rough neighborhood in the midst of lower growth, as in lower demand, as well as higher interest rate, it would hurt industries that are on the high leverage side. You sitting here probably have a much better sense of which those industries are. I think about the technology sector as well as the property sector, but maybe there are others.
Great. Thanks, Naimur. I think we have time for perhaps one question. Maybe I'll take that gentleman back there. I think you had your hand up first, sir, so we'll give it to the gentleman back. Now the other one. Yeah. Go ahead, sir.
Yeah, hello. My name is Dr. Animesh Nuskar from Hansraj College Economics Department. I have a question on regarding the monetary policy. First of all, the first question is this monetary policy hawkish? And the second thing is that if this tight monetary policy continues, and to tackle this inflation, when the inflation is responsible for most of the supply side factors, so what should be the accommodative fiscal policy which can help us to achieve the 5 trillion economy? Because tight monetary policy, it has a negative impact on the investment-led growth. And other side, what should be the fiscal incentives so that, there should not be any policy, there should not be any conflicting in the policy goals.
I'll just take 30 seconds. We have an ex-MPC member here who is the right position. We should just need to put this in perspective, right? Temur says it's really important in periods of high inflation to look at real interest rates. I would not characterize India's monetary policy as being excessively tight. In 2019, real interest rates were at 2%. Nominal rates deflated by inflation looking forward. Even after the rate hike this week, with policy rates at 6.25, even if you go forward and say inflation is going to fall to 5.2%, which is what the RBI says, real interest rates are 1%, right? And I would not call that excessive by any stretch of the imagination, especially what's happening globally, and given that expectations have hardened. Fiscal policy also, I think we have to accept, has been very accommodative. If you add up the center's deficits, state deficits, these are large, and they will over time have to come down for the reasons Chetan mentioned, Nilkant mentioned, I mentioned. So I think we have to recognize that in this dangerous 12 months that we're going to face, right, with policy already being accommodative, monetary and fiscal from the pandemic, we need to tighten our seatbelt a little bit and focus on stability. Where will the growth support come from? It will come from public investments, the quality of spending, not the size of the aggregate deficit. But just underscore one last point Temur made. If the global economy is going from 6 to 3 to 1.5, all EMs are going to slow a little bit. India will be no exception. Think of this as what's necessary to bring imbalances down and protect and preserve macro stability.
So, U.S. monetary policy is going to remain tight for a while. We're not going back to possibly pre-COVID interest rates anytime soon. And one of the things that is different about, it's important to distinguish a pandemic recession from a regular recession. In this particular recession, even though central banks have tightened, you don't really see the impact on their job markets having softened much. So what that suggests is that one may not see deep contractions in these economies, and in that sense it's good because you get a soft landing. But on the other hand, unless you don't see substantial softening of job markets, trend core inflation certainly is going to stay high, and that's going to keep interest rates elevated. So I think part of the strategy of central bank EMEs is to figure out, whether they want to keep an interest rate differential and so on. But that's going to be something that is going to be around for the next few quarters or years.
Great. Okay, I think we're out of time. We need to kind of get ready for the next session that Suman Berry is joining for in a few minutes. But I'd like to thank all the panelists here. I'd like to sum it up by cautious optimism, and I think industry will always take a bit more optimism than economists have. So that's a perspective we'll take. But thank you so much for all of your inputs, and thanks again to the audience for joining us today. Thank you.